Hi, I'm Howard Ward, GAMCO's Chief Investment Officer of Growth Equities, and as we reflect on the third quarter and the market outlook, the question on everyone's lips is recession or soft landing. Let's dive in. Thanks to the highest inflation rate since the 1980s and the resulting Fed tightening, interest rates have reached their highest levels since 2007, and a growing number of signs point toward a recession beginning late this quarter or early in 2024. Some argue the massive fiscal stimulus of the past 3 years will keep the economy growing, delivering a soft landing. Now that's a possibility, but we believe such an outcome is unlikely. We hope we are wrong. But the fact is, high rates of inflation, elevated interest rates with an inverted yield curve, and Fed tightening cycles almost always result in recessions. Inflation above 5%, which we easily surpassed, has always led to recession. And inverted yield curves, such as the current one, have predicted 7 of the past 7 recessions. And 10 of the last 13 Fed tightening cycles have ended in recession. We've also seen a spike in corporate bankruptcies this year. No surprise given the surge in interest rates and record levels of debt for the corporate sector, but also, I might add, for the government and household sectors. Among those filing Chapter 11 are Rite Aid, Bed Bath & Beyond, Yellow Freight, and Diebold. Now, the Fed is optimistic, saying the economy is expanding at a solid pace, citing job gains and the low unemployment rate. But unfortunately, job gains and the unemployment rate are not leading indicators, they are lagging indicators. I suggest the Fed look at the Conference Board's index of 10 leading economic indicators. This important index has been negative for the past 18 months, and every time that's happened, we've had a recession. The bottom line, a recession is more likely than not. A 70% probability sounds about right. Yes, the economy grew in the third quarter and so will earnings. And the fourth quarter, you should still expect to see some growth in GDP and corporate profits. But by the first quarter of next year, expect that GDP may turn negative and expect the earnings reports or earnings estimates for next year to be cut as well. Some companies will surely report impressive growth and robust profits, but in a recessionary environment, which we project, that usually weighs on the stock market, either through earnings, multiples, or both. The good news is the Fed is projecting cutting rates next year, and on that we can agree. Looking beyond the near-term recession concern, we believe the intermediate and longer-term outlook for stocks in general, and our companies in particular, are favorable. The ensuing slower growth, lower inflation, and interest rate environment is just what the stock market craves. Now, as many of you know, wealth creation by way of the stock market usually requires patience. And I thank you very much for tuning in today.